Hello and welcome back to Economy Beat, the channel where we dig deeper to uncover the financial truths the mainstream media often ignores. I'm your host, and today we're tackling a metal that's been on an absolute tear: silver. With silver prices surging past $76 an ounce, many investors are getting vertigo, wondering if a sharp correction is just around the corner. But what if I told you we might still be in the early innings of a historic silver bull run? According to one expert, the precious metals world could be on the verge of a price shock that sends silver into triple-digit territory. I recently sat down with Peter Krauth, the publisher of SilverStockInvestor, to get his take on this explosive market. He argues that silver breaking its 45-year-old all-time high of $50 is not the end of the story. It's the beginning. In his view, that $50 mark is transforming from a ceiling into a solid floor. Now that we're in uncharted waters, the old maps don't apply. So, how do we navigate? Krauth says the key is the gold-to-silver ratio. For those unfamiliar, this ratio simply tells you how many ounces of silver it takes to buy 1 ounce of gold. A higher ratio means silver is undervalued relative to gold, and a lower ratio means it's overvalued. Historically, this ratio has seen dramatic swings. Krauth pointed out 5 major drops in the ratio going back to 1997. If you average those drops, you get a 44% decline. So let's do some math. The ratio peaked recently in April at around 105. A 44% drop from there would bring the ratio down to about 59. Right now, it's sitting around 67. So, even if gold just holds steady at $4,000 an ounce, which is a conservative scenario, and you divide that by a ratio of 59, you get $67 silver. We're already there. That's essentially his baseline case. But what if gold doesn't just stay put? Let's say gold holds a slightly higher ground at $4,400. And let's assume the gold-to-silver ratio simply reverts to its average since 1997, which is around 55. We're not even talking about an overshoot here, just a return to the mean. 4,400 divided by 55 gives you $80 silver. That figure takes us right up to the recent highs we saw before the latest pullback, suggesting the market dynamics are playing out just as the historical data would predict. Now, this is where it gets really interesting. This is just the average scenario. The truly bullish case considers 2 factors: a higher gold price and a more aggressive drop in the ratio. Many major banks are forecasting gold to approach or even exceed $5,000 by 2026. At the same time, historical drops in the gold-to-silver ratio often overshoot the average. So, let's explore Krauth's bullish scenario. Imagine gold hits $5,000, and the ratio drops to 45. 5,000 divided by 45 gives you $111 silver. And a ratio of 45 isn't even the most extreme we've seen. In 2011, the ratio plunged all the way down to 30. If we just take the average of the last few major drops, we could easily see a ratio around 40. Now let S run those numbers. $5,000 gold divided by a ratio of 40. That puts silver at $125 an ounce. Let that sink in. We're talking about a potential doubling from today's already elevated prices. Of course, every analyst worth their salt considers the downside. In Krauth's more bearish outlook, gold could pull back to support levels around $4,000 or even $3,800. If that happens, and the ratio reverses course back to the 78 or 80 level, we could see silver find a floor. At $4,000 gold and an 80 ratio, you get $50 silver. At $3,800 gold, it's $47.50. So, a support level in the high 40s seems like a plausible floor in a corrective phase. But price targets based on ratios are only one part of the story. The real wildcard for 2026, the potential black swan event, lies in the physical market. While factors like Fed rate cuts and solar demand are well known, the extreme tightness in physical silver supply could trigger a price shock that's impossible to time. Krauth describes the current situation in the physical silver market as a shell game. Inventories in Shanghai are at their lowest levels in a decade. London remains incredibly tight. We've seen massive amounts of silver moving between exchanges, from London to New York to avoid tariffs, then back to London, and most recently, a significant amount coming out of China. But as Krauth emphasizes, moving silver around doesn't create more of it. You have the same amount of metal under the shells. It's just popping up in different locations. And here's the critical point. Shortages in New York, London, and Shanghai are not equal. China is where a massive amount of industrial silver is actually consumed. Think about it. An investor who can't get a paper silver contract can simply buy a different asset. But a manufacturer building solar panels or servers for AI data centers needs the physical metal. There is no substitute. This sets the stage for what Krauth calls a crying uncle moment. Imagine a huge industrial user holds a futures contract for, say, 20 million ounces. They stand for delivery. The exchange stays quiet until the last minute, and then says, "Sorry, force majeure. We don't have the metal. We have to settle you in cash." The company replies, "We don't want the cash. We need the silver to run our factories." That story would make major headlines. The revelation that the physical metal isn't there to back the paper contracts would cause silver to gap up violently. This isn't just speculation. The Shanghai Futures Exchange built its credibility on its ability and willingness to deliver physical metal. Many Asian contract holders aren't just hedging. They're positioning for actual delivery. A failure to deliver there would be a massive blow to confidence and could ignite the market. All of this paints a very bullish picture for silver leading into 2026, with the risks heavily skewed to the upside. And this brings us to market psychology. As gold solidifies its position above $4,000, regular people start paying attention. They feel they missed the boat on gold, which at over $4,000 an ounce seems prohibitively expensive. So they look for an alternative. And what do they see? Silver. At $60 or $70 an ounce, it looks incredibly cheap by comparison. They do a little research and discover that the gold-to-silver ratio is still historically high. They realize that even if gold goes nowhere, silver has a strong, fundamental case to move higher. This is where FOMO, the fear of missing out, kicks in. A new wave of retail investors could pour into the silver market, adding fuel to an already burning fire. So, to summarize, we have a historical precedent for the gold-to-silver ratio to compress dramatically, which could send silver into triple digits even with conservative gold price targets. More importantly, we have a physical market stretched to its breaking point, with critically low inventories in the one place that needs it most for industrial production. A delivery failure in Shanghai could be the spark that lights the fuse. The coming months will be critical. Will the shell game continue, or will one of the shells finally be lifted to reveal nothing underneath? It's a high-stakes scenario, and for investors who understand the dynamics at play, it could present a once-in-a-generation opportunity. That's all the time we have for today on Economy Beat. What are your thoughts on the future of silver? Do you see $125 in its future, or is this all just hype? Let me know in the comments below. Don't forget to like this video and subscribe to the channel so you do not miss our next deep dive. Thanks for watching.